Our top story this morning, the GST Council, which is currently deliberating on a major move bringing aviation turbine fuel or ATF under the Goods and Services Tax framework, according to media reports. Currently, ATF is subjected to an 11% central excise duty with a reduced rate of 2% available under the Regional Connectivity Scheme. On top of this, value-added tax or VAT is still levied at varying rates depending on the state, creating complex and inconsistent tax structure. Now remember, the GST Council meet is scheduled for tomorrow, Saturday, but bringing ATF under GST, what would this mean for you, the consumer, who also happens to be a high flyer? Joining me to discuss this and more this morning is Mr. Ambareesh Baliga. Ambareesh, good morning. Thank you for being here on News9. A lot of speculation about what Finance Minister and the group of ministers, the GST Council, will come out with in that meeting tomorrow. But ATF under GST, what does this mean? How does this augur for prices of airline tickets?
Good morning, Kartik. As far as ATF is concerned, and if it's brought under the GST ambit, I think it would be good for the aviation sector as such, because they'll be able to take that set off, which was not available earlier. As far as the customers are concerned, I don't think it'll be, too much of a difference as far as they are concerned. But it's very much possible that in case, this happens, airlines will be able to, have their fares slightly lower than what it is right now, because they'll have that much of cushion. So that's the only benefit which I think the customers will get. Otherwise, I don't think there'll be too much of a difference as far as the customer is concerned.
No, not much difference for the customers. That's not good news coming in this Friday morning with the speculation around AFT being under GST. But talk to us in general. What are the markets factoring in, or what are the markets expecting from this 55th GST Council meet scheduled tomorrow? There are talks about perhaps the health insurance also seeing a revised lower GST. What are the markets expecting, and what have they already priced in?
See, I think there are two major things which the markets are factoring in or trying to gauge. I think the first one is the new slab which people are talking of 35%, which again will have a number of sin goods or the luxury goods getting into that. And one of the goods which are commonly used is textiles, apparel. Priced more than, I think, 1,500 rupees, which they're expecting it to go to the higher slab. I think that would be negative for that space, especially the textiles and apparel space.
Okay.
The other one is about the life insurance, which would get into this ambit at possibly a lower GST. I think that would be quite positive. For the customers as well as the life insurance companies, because clearly you'll get a much better sort of a cover at the same price, which is good for the consumer. And because of this, possibly, the demand also can move up, because people would possibly look at higher covers going ahead.
Okay. There were also talks last time around, Ambareesh, if I remember correctly, about introducing a 15% slab, so possibly moving up certain 12% basket of goods and services into 15% and parallelly reducing some 18% slab items to 15%. Do you think there is merit in the government trying to do that?
Yeah, it's very much possible that the government could, in fact, introduce that slab, but it's very difficult to give, comment on that right now without knowing as to which are those goods or services which can move from 12 to 15, and the ones which can come down from 18 to 15.
Okay, difficult to comment at the moment. Well, of course, we will know this only tomorrow and we will bring that up. But Ambareesh, stay with us, staying with taxes and staying with the cost of items that you buy. Well, imagine picking up your favorite snack pack only to find that it feels and in fact is much lighter. Well, it won't really be an illusion, because shrinkflation is back at work. Companies are battling rising costs of wheat, cocoa and edible oils by shrinking pack sizes or subtly raising prices. Well, big players like Britannia, Parle, ITC and Godrej are tweaking their strategies to cope. So expect prices of biscuits, cakes and packet staples to climb up as much as 7% in coming months. Well, in fact, Britannia CEO Ranjit Singh Kohli confirmed a 3 to 5% price hike ahead, along with reduced pack sizes. an effort to balance rising costs without overwhelming consumers. With edible oil prices up 40% year on year and a new 20% import duty adding pressure, the industry faces tough choices. So your shopping basket might soon feel a little lighter on quantity but a little heavier on the wallet. So shrinkflation, Ambareesh Baliga, it's here, it's back again. What does this really do for the consumer, and what does this do for the margins of the FMCG companies?
See, despite the shrinkflation, I think the margins would be under pressure because you can't shrink beyond a certain level. I mean,
Right.
if you're giving, say, 20 grams of wafers, you can make it 15. You can't really make it 10. Otherwise, you need to raise prices. And if you're raising prices from the minimum slab, like most of these snacks, the smallest packets have been available at 5 rupees. Now, five, you don't make it six, you need to make it 10. So that is also not possible at this point of time. So overall, I think it will like result in a slightly lower sort of demand because of the inflation overall, because that's the first thing people cut when there's inflation.
Right.
And at the same time, like I said, like the margins would be under pressure because they'll not be able to reduce the grammage
Right.
to a very large extent.
Well, Amrish, just to point a little case study we were discussing just before this show in the newsroom, a young boy in the team happened to tell me that ever since he was born, the Parle-G packet has been 5 rupees and it hasn't really changed while the quantity has come down. So that's in line with with what you're stating. But so is the case, in fact, across pretty much all FMCG products. You don't really see the prices go up and you see quantity reduce. So, I mean, is it okay to continue with this shrinkflation, and how does it work globally? Is it time to now actually address inflation as inflation and raise prices?
I think so. I think somewhere the companies need to bite the bullet and say that the costs have gone up, so we are increasing prices for the same grammage. Like I said, I mean, beyond a certain level, you cannot reduce. I mean, the size, because, for example, you're talking about the Parle biscuits. I
Yeah.
mean, Parle biscuits, as of now, if I'm not wrong, you get six biscuits in that 5 rupee packet. You can't bring it from six to two biscuits. It's just not possible.
Right. So, I also want to understand the implication of this 20% import duty on edible oil, and edible oil prices have risen 40% year on year. Now, that is obviously something which is really huge for the consumer who actually depends on edible oil for the basic needs of cooking. What can the government do, or what can companies do to actually curtail this? I mean, can we increase production domestically, reduce dependence on import oil, or are we going to be in this sort of, import era from countries like Malaysia, etc., for much longer?
See, the major import of edible oil is palm oil. And as of now, the Indian production is not enough to meet the demand. And as long as the prices go up, clearly the input costs for the Indian companies will surely go up, and they'll have to increase prices for the retail. And whatever we're talking about, I mean, that 5.5%, 5.75% inflation, I mean, that's only a number. I mean, you ask a person on the street as to how much his monthly bills have gone up by. I mean, the figures would come nothing less than 15-20%. So the actual inflation, I mean, at the ground level is much higher than what is being stated. And this is what is putting pressure on the overall demand, especially the urban demand, which we see is coming down, is basically because of this.
So, is there something that the government can do? Because we've seen that whatever the Reserve Bank has tried to do, Amrish, hasn't really cut it beyond a point, because headline inflation is what the Reserve Bank looks at, and supply side issues are something which is difficult for a central bank to control. So, is there something that the central government can do to tame inflation, or we just take inflation as fait accompli and move on with higher bills month on month?
See, the biggest inflation, I mean, issue is with the food items. And the government has been talking of managing the supply chain, ensuring that the supply chain is smooth in the last 10 years. But nothing much seems to have been done about that because if you're talking of the cold storages, you hardly see, I mean, fresh new capacity coming up in that space. And that is what is creating the issue as far as I mean, the food inflation is concerned. I mean, you require storages, whether it's, whether it is cold storage or the regular storage. And you need to also smoothen the supply chain, which is where I think we are taking a hit. I think the government still needs to do a lot more as far as that is concerned to ensure that the price fluctuation as well as the inflation is kept under control.
All right, so supply chain is the name of the game. Amrish, I want to move from shrinkflation to shrinking bond yields. The yield gap between US 10-year Treasury bonds and Indian 10-year government securities has shrunk to its lowest level in nearly 2 decades, a development that could majorly impact foreign portfolio investor inflows or outflows into Indian debt, government debt. According to market experts, this narrowing spread might even trigger outflows. The shift comes as US 10-year yields surge, driven by the Fed Reserve's hawkish stance. Foreign investor Ambareesh Baliga, this narrowing gap between what the US 10-year Treasury offers and the Indian government bonds, how does the life of an investor invested in debt products really change?
No, see, first of all, I mean, why do these FPIs or FIIs invest in the Indian bonds? Because I mean, the gap is decently large, and that takes care of, I mean, the difference in the risk profile of both these countries. But then, when you see the yield narrowing, it doesn't make sense for them to remain invested. So it's quite natural that they would prefer to go to the geography where their I mean risk is lower than an emerging country like India. So naturally, when I mean when they exit, clearly the bond prices will fall and the yields will increase. And that is the time possibly they could again look back. But as of now, I mean, I clearly see FIs possibly exiting and getting into the US bonds.
Right, well, that is the FII, FPI game playing out. Let's move on to something else. We've seen this fact. This has been a week of some stellar startup IPOs that we have seen. MobiKwik being the outshiner among all the IPOs that we saw this week. Now, there is also another story of this winter funding which is beginning to thaw. And overall, according to Traction India Tech Annual Report 2024, India has emerged as the third largest startup tech ecosystem globally, raising about $11.3 billion in funding. And India happens to have surpassed China and Germany and falling behind just US and the UK. Now, there has been a 6% increase from 10.7 billion in 2023, but a sharp 56% drop compared to the year before, which is 2022. So, Ambareesh Baliga, at this point, is it fair to assume with inflation in the US coming closer to the 2% range, we saw a higher 2.7% later, in the month of November. But overall, is it fair to assume that this funding winter that startups were faced with across the world is now beginning to thaw, or do you feel this is just a minor 6% increase and we can't really establish a trend line from here?
No, I think it should continue to thaw because, I mean, clearly, like the amount of money which is actually made in the startup system is much, much larger than the amount of money which you make investing in secondary markets. I mean, especially globally. I'm not talking of India because India clearly has given extremely good returns in the last 3 to 4 years. So, I mean, clearly, I see again money moving back into the startup system. So, we should see, I think, better sort of numbers going ahead.
What does this mean for startups that were looking to first shift domicile back into India from countries like the US or Singapore and other countries, hoping that this funding winter that they were faced with could partly be offset by listing in the Indian markets and coming out with IPOs? So, going forward, do you think that trend of startups listing on Indian bourses is likely to slightly slide away if the funding season from private capital improves?
No, I mean, going ahead, I mean, the startups looking at India for the IPOs, yes, I think even that we should see, I mean, the trend changing.
Mm-hmm.
Uh, because if you see 2024, I mean, the amount of funds which have been raised in the IPO, I think it's a record if you're looking at the last, I mean, few years. It's clearly a new record which you have created this year. And especially if you're looking at the SME, I think it's the mind-boggling numbers which have come out there. I mean, when you talk of startups, when they are ready for an IPO, I think the Indian markets would clearly provide them the right amount of funding.
Okay. Well, let's stay with the stock markets. And in fact, what a week this has been, Ambareesh Baliga. In fact, starting from the massive swing last Friday, and now we are sitting on another Friday and the last 5 trading sessions. And let's see how today shapes up. But investors have witnessed a massive erosion of wealth, with the Indian equity market shedding almost 10 trillion, exactly 9,65,000 crore rupees in just 4 days of sharp declines. The BSE benchmark Sensex plunged by almost 3,000 points, marking a 3.5% drop over the period. In fact, yesterday the Sensex fell for the 4th consecutive day, losing 1.2% at its lowest point during the session. The index has dropped 1.44%. So, overall, how do you view the market mood from here, Ambareesh Baliga? We've seen massive erosion of wealth, but there were factors which weren't really in our control, and not least the Fed commentary coming in. But going forward, 2025 around the corner, just a week or so to go. So how do you see the mood of the markets from now, from today's trading session until perhaps Donald Trump assuming office, or let's say budget presentation by the Finance Minister of India?
See, Kartik, in fact, I've been cautious for a while, clearly looking at the sort of valuations, the steep valuations which we are quoting at. And recently, we have seen that the macro numbers also have been concerning. Q1 earnings had started showing a downtick, but people thought, I mean, that's just a blip. Q2 was mostly disappointing, and that's when we started seeing the markets correcting. And now, when the Q3 comes, starting January, about 8th or 10th of January, we'll start seeing the Q3 earnings coming in. I really don't see that Q3 earnings could be any way better than Q2, could be worse in specific sectors. So I think that is what is bothering the markets. And we saw that fall starting from 26,000 plus on the Nifty. And we had a good correction of about 3,500 points. And after that, we have seen 1,000 points of a bounce. So this was only a bounce. And now again, we have started the downward journey.
Okay.
And I mean, I'll not be surprised if we see levels closer to about 22,000 over the next month or so.
Ah,
Because in addition to the Q3 earnings, which could be disappointing, like I said, the additional volatility will be added from January 20th when you have the Trump's inauguration day. And from then on, I think on a daily basis, you'll have extended sort of volatility based on the sort of statements which come. Because one thing we are clearly bothered about is how the tariffs could play out.
right. So tariffs, of course, is top of mind for everybody. And like you mentioned, a muted Q3 or a subdued Q3 could also spell trouble. And I think the headline you're giving us, Ambareesh, is that your expectation is that the market would see 22,000 levels. Well, I'm not sure investors are going to be very happy this Friday morning listening to you. But it's a pleasure for us at News9 to have you with us, Ambareesh Baliga. Thank you so much for taking time out and being with us here today.